Hello again, everyone. It is Thursday, April the 8th, 2021. I'm John Kosar from Asbury Research and Asbury Investment Management, and this is your Daily 5. These are my 5 favorite charts and data series that I think are going to be the most influential in the upcoming weeks. Number 1. The benchmark S&P 500, the trend is your friend. One of the most important things that I have seen here over the past month or two has been the resilience of the broad market S&P 500 to stay up above its what we would call tactical support. The buy the dip mentality is very strong. Even over the past couple of months, when you've seen the typical leaders underperforming, the semiconductors, technology underperforming, the defensive Dow outperforming, that drive by investors, to buy the dip is very much alive and well. Let's look at the chart a little more closely. Here's the March 2020 uptrend line here in pink, dashed. The 50-day moving average is here in blue, and the 200-day is here in orange. I look at the 50-day moving average in the March 2020 uptrend line, or I have for the past several months, as being tactical support. That's, to me, where the market has to hold in. If the move higher that began in the beginning of November of last year is still healthy and intact. So you see we had 3 tests here. January 29th was our first test, and then we came up and made a fresh high, and then we had another test here, borderline breakdown, but it held, and March 4th, and then right after it was March 5th here. We made a slightly higher high, but really couldn't do anything with it. Came down again, tested it a third time on March 25th, and then up and away we go, and we're at new all-time highs as I am talking to you this morning. Tactical support right now, in our view, starts at 39.67, which is that March 2020 uptrend line, and extends down through to 39.02, which is the current location of the 50-day moving average, with 39.50 right in the middle, which is the February 16th benchmark high. It's a broad range for support level. I usually like to have them a little tighter, but the chart is what it is, and that's where that support is right now. It's 3 to 4% underneath the market. As long as we can stay up above it, tactical trend is intact. And way below the market, strategic support or major support is 12 to 13% underneath the market at 35.88 to 35.50. That's the 2 highs that we made here at the end of last year, benchmark highs, as well as the 200-day moving average. Number 2. Market internals. The Asbury 6 is positive. The Asbury 6 is our own internal metric. It's a model that we put together, obviously, with 6 different indicators that are meant to measure the internal strength of the market and to, as much as we can, ignore the day-to-day gyrations in the S&P 500 that have really become commonplace now. A lot of this, I think, has to do with computer trading, algo trading, where you'll have the S&P down 30 in the morning, up 40 in the afternoon, and then down another 30 overnight. It's really hard to lose track of what's important when you're watching this crazy gyrations day after day. So we built a metric that measures the internal strength of the market. Of these 6, the only one that has to do with price is the rate of change in the S&P 500. So it's a derivative of price of sorts, but the other 5 are secondary indicators like volume, corporate bond spreads, investor asset flows, stuff that can't really be affected by the day-to-day gyrations in price. So we update this every day in our research center, positive since March the 11th. That was 5 days after that second test of tactical support that I talked about in the first chart that took place on March 5th. As long as the Asbury 6 stays positive, 4 or more green are necessary to be positive, and we stay up above the tactical support in the S&P 500, we're going to ride this trend as long as it wants to go. Number 3, chart patterns. Tech is leading again. The last Your Daily 5 that I did was 3 weeks ago to the day, and one of my concerns was that the leaders weren't leading. Tech was underperforming, semis were underperforming, and the defensive Dow 30 was outperforming. That's usually what happens when the market is weakening and starting to go into a corrective phase. Now, sometimes that phase, the corrective phase, sometimes that corrective phase is an internal one. It's atypical, but it happens, and I think that's what we saw this last time, is you had a lot of churning over a couple of month period where tech and semis were underperforming, small caps started underperforming, the Dow 30 was outperforming, so was the NYSE Composite Index, but the S&P 500 held its ground. I think that's the kind of correction we had, and it looks like we're coming out of it now because we had a technical breakout on April 1st in the comp. NASDAQ Composite Index is the larger of the two NASDAQs. It actually gapped higher on April the 1st to confirm the breakout of this pattern. Gaps indicate urgency. A lot of buying pressure there, so you form a little price gap or index gap on the chart. This pattern targets an additional 7% move higher to 14,700 as long as we stay above this 13,125 area. So that's a big deal. It indicates to you that you're getting a little leadership out of the traditional parts of the market that show strength when it's going higher. The sister slide to that is slide number 4, relative performance. Tech is outperforming again. I had mentioned that I was concerned about the relative underperformance the last time I was with you 3 weeks ago. Look at what's happened since then. Back on February 16th, the top chart, let's start there, starts in the middle of November of last year. It's the NASDAQ Composite Daily with its 50-day moving average, which you see here in blue, and it also has the March 2020 uptrend line in the comp in green. Down in the bottom is the daily relative performance of the comp versus the S&P 500. This is where we measure our relative performance, and underneath there is a 21-day moving average in red. And so that tells us what the tactical or monthly trend is of the relative performance line. So the comp peaked in the middle of February, but relative performance peaked about 5 days sooner on February the 11th. You can see on February the 18th, the relative performance line fell through its 21-day moving average, indicating a tactical trend of relative underperformance by the market-leading comp. That was the precursor to this weakness here, where the comp actually broke its 2020 uptrend line, fell through the 50-day, came back and retested it here in on March 22nd, kept the trend intact, but look what's happening now. The relative performance line is starting to move back above the 21-day moving average, indicating an emerging trend of relative outperformance by comp as it's breaking out from its technical pattern that we showed on slide 3. And in the meantime, up top, we're back above the 50, and we're trying to regain that March 2020 uptrend line. So I'm watching this one very closely over the next few days. As long as the comp continues to outperform the S&P 500 on a tactical basis, that makes me feel a lot more comfortable about reaching our upside target in the comp that we showed you on the previous slide. Finally, seasonality. Enjoy April while it lasts. This is a 63-year chart of the seasonality in the S&P 500 through March of this year, and you can see April is the strongest, seasonally the strongest month of the year. And then after that, we have our sell in May and go away phase. And that May through September period includes for the 5 weakest months of the year. So when I look at all of these different metrics, I try to see if it's telling me a story. The story that I'm seeing right now is tech is outperforming again. Tech is broken out. We have an upside target in tech. The S&P 500 has been able to hold its tactical support level for about 6 weeks, and we've got a seasonal tailwind now through this month. We have 3 more weeks left in this month. We could easily get up and hit that target in the comp over the next 3 weeks. But once we get into May, that's when I'm going to start to worry about the overextension in the market. The market has really come a long, long way since March of last year. So there's my 5 most important charts and data series for this week and your Daily 5. Thanks for watching, and we will see you at the next one.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.